Well, good morning and a very warm welcome to the Sustainable Business Network. My name's Wendy Buckley and I'm chair of the SBN here in North Hampshire. Welcome back after the summer break. I hope everyone had a great summer. And we've got a very interesting session today, which is focused on all of those new sustainability reporting regimes. You can see we do have a full programme today. We're going to open up with Zoe Booth from Carbon Footprint, who's going to take us through the usual legal and market updates. And then we're going to have Zoe Rudge, also from Carbon Footprint, who is going to give the overview about some of these new reporting standards that have dropped over the summer. And finally, for our case study, delighted to have Harsha Thomas from De La Rue explaining how her business has gone about doing TCFD reporting in the context of their other sustainability reports that they've been doing. Without further ado, I'm going to hand over to Zoe Booth for the legal and market update. Over to you, Zoe, please.
Thanks, Wendy. There we go. So just on the top left here, if we go through a few bits that have happened since we last saw you, we have actually had some bad news that we've had no new contracts brought in by developers at the government annual auction for offshore wind. There are claims that the government are not making this attractive enough, with statements being made that the government pricing at the auction hadn't actually taken into account higher development costs, rendering it infeasible for developers. In more positive news, we have had H2 Fly make the world's first piloted flight of a liquid hydrogen aircraft, which took place last month. They actually made 4 successful flights, with the longest being just over 3 hours. And they've actually said that the results of this have been so positive that they are expecting it to double the maximum range of the aircraft that they used by using liquid hydrogen. So they hope that this will open up options for medium and long haul commercial flights in future. Just down here on the bottom left, we've got the Committee of Advertising Practice and its broadcasting equivalent updating their advertising guidance on misleading claims and social responsibility in advertising. This will cover the use of carbon neutral and net zero claims in advertising, which is welcomed news for everyone, I'm sure, and will really hopefully increase confidence in businesses making their green claims, and hopefully reduce a bit of the green hushing, which some of you might have heard of recently. Right on the right hand side there, we've got another first, this time for the UK. With last month we had investments by Stellantis turning the Vauxhall plant in Ellesmere into the UK's first dedicated factory for EVs. This is expected to assemble around 50,000 electric vans per year, with passenger cars being introduced next year, which is fantastic news for businesses. We have also had recently the G20 summit, as I'm sure you'll all know. There's lots of key things that came out of this, but just to summarize a few, we've had no consensus on the phase out of fossil fuels, despite the UN report categorizing this as indispensable for achieving net zero emissions. And as you can see there, G20 nations contribute around 80% of the global emissions, so it would have been nice to see some consensus there from them. One of the key things that you probably would have heard is that we do need more support for developing nations, and they really stress the urgency of providing more climate finance here for those countries to enable net zero by 2050. It's hoped that the new acceptance of the African Union at the G20 will provide an extra kind of 55 rough votes in favour of this going forward, so hopefully some positive news there as well. We have a little bit more on the science-based targets and their beyond value chain mitigation. So they ran their public consultation this summer between June and July, and that was a 62-page consultation document, so quite extensive there. And their aim is to develop corporate guidance to really look into kind of carbon offsetting as you move towards your net zero goals with them. We haven't got the outcomes of that yet, but we should be expecting them soon. But in line with what science-based targets have previously said, the main message here is that beyond value chain mitigation or offsetting is going to be essential for the journey to net zero. The kind of independent one to watch at the moment is the ISO 14068 on carbon neutrality. We should see that coming out late autumn as well. And this will give us a global definition of carbon neutral or net zero, which is really welcomed by the industry actually. And it will be independent, and you can get that certified by any ISO auditor. So that gives a little bit of independence to the field as well. Some of you may have heard of ICVCM and VCMI. So if you haven't, those are the Integrity Council for Voluntary Carbon Markets Integrity Initiative. It's a bit of a mouthful. And Voluntary Carbon Markets Integrity Initiative as well. They actually joined forces this summer for ahead of the summit for New Global Finance Pact in Paris, and they aim to define the best practice. So similar to what we should see in the ISO 14068 actually. It will be kind of up to you guys individually really to decide whether you think this kind of adds value. But what we might find is actually that the ISO itself provides that independent route that actually is possibly more useful. ESOS, phase 3, another update from them. So we have had a change with a pushback on the deadline for this. So this is now going to be the 5th of June 2024 instead of the original 5th of December that we would have seen this year. This change came with only 6 months to go towards the deadline. And as you can imagine, quite a few businesses are not too pleased with the late change here, with a lot of this still being up in the air because the changes that were suggested have not actually been passed yet. You won't be able to submit your phase 3 until they are changed in legislation, but you are expected to prepare for them. We haven't had any recent updates on this. So the last one you can see there was in June from the Environment Agency and the new Department for Energy and Security and Net Zero, and it's still around 8.5 months to go until the new deadline. So hopefully we do see some updates from them soon. Fines are continuing to be issued for water companies. So you can see there Thames Water were fined nearly 3.5 million for sewage dumping, causing kind of catastrophic damage there to the ecology in the river. They've had 4 separate charges that amounted to that quantity. Although we do see a lot of these water company fines, we always kind of, if you've been to an SBM before, you'll have seen this pop up. But it has also recently been revealed that since the legislation changed in 2010 to allow self-reporting, the Environment Agency have missed around 36% of their audits on water companies. So it is possible that there are a lot more kind of sewage dumping activities going on that we haven't captured here at all. You can also see another custodial sentence here over a illegal waste site. So 2 men actually got 8-month sentences in custody for this, and another 2 were fined for their activities on site, mostly revolving around repeated failure to correct hazardous waste after instruction from the Environment Agency. So those are all the links there for you, just in case you want to go and have a look in your own time. Yeah. And my email address as well if you have any questions at all.
Great. Thank you so much, Zoe. That's absolutely fascinating. We will move on to our next speaker, who is Zoe Rudge, Demystifying Sustainability Reporting. Zoe, over to you, please.
Good morning, everyone. Thanks, Wendy. So most of you, I'm sure, have joined this morning to hear about the various sustainability reporting frameworks that are either currently mandated or due to come into force soon. So we're going to be touching on a fair few of those this morning. But firstly, we'll take a think about what corporate sustainability reporting really is. So many of you sat here today, or your colleagues, will be very familiar with financial reporting requirements for businesses. It's been around for a very long time. Sustainability reporting tends to be termed the non-financial performance of businesses and disclosure on how companies are doing with regards to their non-financial performance. Sometimes this is also termed ESG reporting, covering those three pillars of the environment, social, and governance of a business. Sustainability reporting may be required, so whether that's jurisdictionally or in a specific sector. It may be solicited, so perhaps you're being asked to do this by your own supply chain as part of requirements for tendering for work. Or there are also many voluntary frameworks that you may decide to opt in as a business to improve company reputation and show off the wonderful work you're doing around sustainability. Some examples of those voluntary ones include things like science-based targets or the Carbon Disclosure Project, for example. What we're seeing is, particularly in more recent years, much more of an enhanced sustainability reporting expectation. So we've had a fair few new frameworks that have been introduced recently or building upon existing frameworks that businesses were required to disclose against. Particularly, so sustainability covering a broad range of topics, as mentioned under ESG, so things like human rights, biodiversity, social responsibility, but climate change having a really key focus under a lot of those frameworks. We are, of course, as we keep hearing, in a climate crisis after all, so this is being given a lot of weight in terms of sustainability reporting at the moment. When we talk about impact, something that's really important to consider here is this concept of materiality, and you'll see this crop up a lot under various reporting frameworks. So materiality generally is an accounting concept for financial disclosures, but normally this is considered to relate to the importance or the significance of the disclosure. So if you're thinking about materiality from a single perspective, often when a framework talks about something being material, they're meaning, what is this meaning to investors? And if it's material, it would be considered important to investors to understand so that they can make informed decision about their investments. However, we're starting to see more frameworks introduce the concept of double materiality. And this includes not only the impact of the environment on the business, so those are the things like climate risk, which investors would want to be informed about, but also the impact of the business on the environment. So double materiality is looking at this both ways, the impact of the business on the environment and the impact of the environment on the business, so risks and opportunities. It's very important to keep the concept of materiality in your minds when looking at what frameworks you may need to disclose against as a business, because different frameworks have different standards for reporting and disclosure. So you may have seen the alphabet soup that appears to be growing for sustainability reporting. We have many an acronym now across the board, and some of these can be quite confusing. What we're hoping to do today is to dissect some of these for you so that you have a better understanding of what the various acronyms mean, whether they apply to your business or which businesses they do apply to, even if it's not your own. What the reporting requirements are at a fairly top level, so we won't be diving right into the depths of it, but we will be giving you an overview, broadly speaking, of what is expected under different frameworks, and also by when the disclosures are expected. So when you would firstly be required to report and how that trickles down for other businesses as well. We'll also touch on what happens if you need to comply with more than one of these different frameworks and how they operate between one another to avoid having to repeat disclosures in multiple different places, and also what your business can do to prepare for these different disclosures or to enhance what you've already been doing. As I'm sure many of you will agree, enhanced sustainability disclosures are very welcome. We're looking to see businesses become more accountable for their sustainability practices and improve transparency across the board to get a better understanding from business to business how they're performing. But of course, with enhanced reporting comes the requirement for additional resource, additional data that may not already be monitored, and this is causing some concern for businesses around the increased overhead costs, data availability, being prepared, and also getting it right. So hopefully what we touch on today will give you a little bit more peace of mind of what's involved. We're going to start by looking at this from a more global perspective. So as British explorer Robert Swan said, the greatest danger to our planet is the belief that someone else will save it. We know that there's a collective responsibility globally to tackle the climate crisis and wider sustainability reporting. So there are frameworks out there that are aiming to set baselines globally for sustainability related disclosures. A couple of examples here include the International Sustainability Standards Board, which I'll be touching on in more detail in just a moment, and the Task Force on Climate-Related Financial Disclosures, or TCFD, as I'm sure many of you have heard before. And we're going to be hearing a bit more around implementing TCFD in the business by Harsha from Delarue very shortly. Firstly, then, we're going to take a look at the International Sustainability Standards Board, or the ISSB. So the ISSB is aiming to provide a comprehensive global baseline for sustainability disclosure, mainly driven by the need for investors. So they are focusing primarily on that single materiality approach under the framework of the ISSB. The ISSB is governed by the International Financial Reporting Standards Foundation, or the IFRS, which they're widely recognised for setting financial reporting standards globally, and now moving towards also introducing these sustainability reporting standards, with the first two of those already being released. So we're expecting to see standards released across the board for multiple different sustainability topics, but at the moment they've started off by releasing IFRS 1, which is the general requirements for disclosure of sustainability related financial information, and IFRS 2, which is climate-related disclosure. Under the climate-related disclosure guidance so far, what they're looking to see is information on climate-related risk and opportunity to the business. And as part of that, they do require that scenario analysis is used to inform company resilience for climate risk, to be able to inform investors on that. Additionally, they're also looking to see that greenhouse gas emissions are disclosed, including scope 3 emissions where material to the business, where significant, and also any climate related targets that the company has as well. Obviously, there's far more detail than this when you look at the standards. So different disclosures are required for different companies based on size and timelines as well. So we can dig into that a bit further down the line, but the key things here are that you're covering climate risk and opportunity, but also reporting on sustainability information such as emissions. The greenhouse gas protocol must be followed as well when reporting greenhouse gas emissions, and this is considered one of the most widely used carbon accounting and reporting guidance globally. So most companies already are using this. However, there has been consideration when developing the ISSB standards for frameworks that were already existing or were also in development at the same time to make sure that there's some interoperability between these. So the ISSB has taken into account guidance that had already been released by the GRI, TCFD, and the standards that were being developed for Europe, for example. So we are expecting some sector-specific guidance as well, and there may be further requirements for certain sectors. So, for example, the finance sector is expected to have to disclose on its financed emissions as well, and further development of these is expected. But the first of these standards, the IFRS 1 and 2, were released just in June this year, so they're fairly recent. Mandating the ISSB framework will just be up to individual jurisdictions. So again, just reminding that this is a global framework, or the aim is that it would be a global framework, but the individual jurisdictions will decide whether or not the ISSB framework is being followed for sustainability reporting. The Task Force on Climate-Related Financial Disclosures, or TCFD, was created by the Financial Stability Board in 2015. So it's been around a little while. It's currently mandated in some countries, but there seems to be some traction picking up on this, with more countries now looking to require certain organisations to report under the TCFD framework. Reporting focuses on climate-related risk and opportunity, and again is targeted at the needs of investors, with the aim of driving more sustainable investment globally. The TCFD is looking for disclosures under 4 key elements, which have a subset of 11 recommendations for disclosure, covering topics such as governance, so overseeing those that are implementing your business's sustainability strategies, managing that and ensuring accountability; company strategy on resilience against climate and other sustainability impacts, and strategy on handling that, which ties in closely with the risk management as well, managing risks within the business relating to sustainability, and what processes there are for managing that. And also metrics and targets relating to sustainability disclosure. So this does also include reporting of greenhouse gas emissions, including scope 3 in some cases, based on individual business sizes or how it's been mandated in certain jurisdictions. Again, the TCFD has been endorsed by many different frameworks or considered when developing new frameworks, but often the TCFD has been used as a building block for disclosure. So for example, TCFD closely aligns with the ISSB guidance, but the ISSB does go a little bit further than just TCFD reporting. So aligning with one doesn't necessarily mean you're compliant with another, and you'd have to give consideration to the different frameworks to understand what may be needed beyond what you've done so far if you're reporting, say, just against TCFD. So we're going to think about this slightly more localised now. So looking at what's going on in the UK, as we've already had mentioned this morning by my colleague Zoe, ESOS is currently in phase 3 with some updates to that more recently. Also actively completed by businesses every year in the UK is Streamlined Energy and Carbon Reporting, or SECA, applying to those businesses with more than 250 employees and meeting certain financial requirements. We also have other more specific frameworks for tendering for certain contracts. So for example, the UK government's Procurement Policy Notice 0621, or PPN 0621 as it's often termed, which addresses sustainability reporting specifically for companies tendering for government contracts over 5 million. More recently, the UK has mandated TCFD reporting in some cases. So for certain organisations, such as finance institutions or large businesses, whereby we mean businesses that have a turnover of more than 500 million and more than 500 employees, are required to report under the TCFD framework within the UK currently. And this has been since April 2022. We're expecting to see that rolled out further to other organisations as well over time. And most recently, we've seen an indication that the UK is expecting to adopt the ISSB framework as part of its own new sustainable disclosure requirements regime. Currently, the UK is in the process of setting up an endorsement mechanism for this, which we're expecting to see within the next 12 months. The idea is that it will follow the ISSB framework as closely as possible, deviating only if necessary for UK specific requirement. So more to come on that. Europe has recently had arguably quite a significant overhaul in terms of sustainability reporting with the release of the Corporate Sustainability Reporting Directive, or CSRD as it's known. So many acronyms here, brace yourself. We've got the CSRD, which replaces what was previously the Non-Financial Reporting Directive, or the NFRD. So this applies to companies registered, EU registered companies that are listed on an EU regulated market, and eventually this will also roll out to companies that are not registered within the EU but have significant activity within the EU, defined by turnover, expected to be over 150 million turnover within the EU, for example. The rollout of this will come at a staggered approach for businesses. So not all of those companies or types of companies just mentioned will have to comply straight away. It's going to trickle down, starting with the largest companies first. So initially, the NFRD coverage was around 11,000 companies. The rollout overall for CSRD will cover more like 50,000 companies. And the companies who are expected to comply first are going to be those that already had to comply with NFRD, as well as other large EU listed companies, so those with more than 500 employees typically. And we're going to see the rollout trickling down to others over time, with the first compliance dates as early as 2025 for the financial periods starting on or after the 1st of January 2024. The following year, we'll see that trickle down to companies that are listed on EU regulated markets that can meet 2 out of 3 criteria, which is based on employee numbers, so being over 250 employees, or with a turnover of over 40 million euros, net turnover that is, or 20 million euros on the balance sheet. That will be for compliance in 2026 for financial year 2025. And then smaller businesses that are EU listed and other businesses with significant activity in the EU expected to disclose further down the line. The disclosure framework for Europe is being developed in accordance with the European Sustainability Reporting Standards, or the ESRS, and this is being developed by the European Financial Reporting Advisory Group, EFRAG. The coverage for the reporting in Europe is considered to be the most comprehensive of the recent frameworks that have come out. So this is covering a really wide range of environmental, social and governance issues, including climate change, biodiversity and human rights. The framework looks at this from the perspective of double materiality, so not just the impact and importance from the perspective of investors, but also the impact that the business is having on the environment, which means that emissions reporting will be comprehensive, again required to carry out climate-related scenario analysis to ensure company resilience and demonstrate that. And external assurance on sustainability information is mandatory under this framework. Disclosures must also be provided in the company's management report to ensure transparency and alignment with financial information. And there's a requirement to digitally tag this so that it's easy to access that information as well. The first set of 12 sustainability reporting guidance by the ESRS was released on the 31st of July 2023. So again, very recent. And we're going to see companies begin to adopt that over time. Again, there is some interoperability as well with CSRD and other frameworks, but often the CSRD will require more than the other frameworks currently do. So this will be the one that companies will need to take most consideration for if applicable to your business, because there may be other disclosures that aren't required under other frameworks that are within CSRD. Now, in the US, they don't currently mandate ESG disclosures, but there are some proposed intentions to enhance the standardization of climate-related disclosures, and this has been proposed by the US Securities Exchange Commission. This would apply to the largest businesses within the US first, so large accelerated and accelerated filers, and again, with the expectation that this would expand down to smaller businesses over time. The US proposal for enhancing sustainability reporting is aimed at, again, what investors would need to know. So it's closely aligned to reporting styles of TCFD, looking at climate risk, opportunities, governance, etc. This does also still include the disclosure of greenhouse gas emissions and intensity metrics and targets relating to those as well. Also, the potential to include Scope 3 emissions where relevant to a business or where considered significant. Again, the US proposes, if the framework is approved, that assurance should be provided on scope 1 and 2 emissions for larger businesses, and disclosures should be made in registration statements and annual reporting for companies. Certain climate-related financial metrics are also required, and this will depend on the type of business as well. But at the moment, these are just proposed frameworks, so we know that these are in consideration, and there has been quite a comprehensive period of feedback where there were some concerns raised by US businesses. So we're expecting to hear more on that in the future, with expectation on an update in autumn this year. There are also many voluntary frameworks that companies are choosing to disclose against now. So many of you will have heard of the Science Based Targets Initiative, the Carbon Disclosure Project, and also other frameworks such as BSI, who have their PAS 2060 standard for carbon neutrality, and PAS 2080 for carbon management in the built environment, for example. Also, reporting standards under the ISO frameworks, so ISO 14001, ISO 14064, and as Zoe mentioned earlier today, we're also expecting soon the ISO 14068 for carbon management and neutrality, which will be very welcome, particularly for those global definitions on net zero and carbon neutrality. So we look forward to seeing what is included within that, and we're expecting that ISO 14068 will align closely with what has been done by the BSI for PAS 2060 carbon neutrality standard as well. So companies may choose to disclose under the Science Based Targets Initiative or CDP. These sorts of frameworks are voluntary and will enhance the work that companies are doing internally on their sustainability, as well as including within global frameworks where others are also disclosing. So for example, the Science Based Targets Initiative, if you have an approved target by the Science Based Targets Initiative, that demonstrates a reliable framework by which your targets have been assessed and helps to demonstrate the process that your company has gone through. So some companies are choosing to go down these routes to add weight to their sustainability reporting alongside any of the mandatory frameworks that they're required to report against. So in summary, what we've covered here today so far is a range of the current and new sustainability reporting frameworks globally, which businesses these apply to and by when, and what the reporting requirements are at top level. There's a summary table here for you which indicates under which of those frameworks companies are required to report and by when. So these slides will be available after if you'd like to look at that in more detail, and supporting information can be sent through as well if you're not sure whether or not this applies to your business. So lastly then, we think about what your business can do to prepare. So firstly, as a business, you would need to evaluate the mandatory reporting requirements that are relevant to you based on jurisdiction, your sector, and also supplier requirements. So when you're required to comply will depend on these factors, and also the size of your business based on employees and finances as well, and the sector that you're in. Once you've considered which reporting requirements may be relevant, you may also choose to consider voluntary disclosures that might benefit your business and also hopefully tie in with the mandatory reporting that you're already doing. And in order to understand what needs to be done in addition to your current reporting to be compliant with the frameworks that you are required to report against or are choosing to report against, we recommend you carry out a gap analysis to get an idea of what is required to be compliant and to ensure that you're prepared as a business ahead of any deadlines for compliance. It's never too soon to start preparing. As mentioned, data availability is considered to be a significant challenge for businesses under enhanced sustainability reporting, and monitoring this now will save the headaches in the future when trying to scramble to gather all the information ahead of any initial reporting deadlines. So if you think that you may be due to report under one of these frameworks, either in the initial years or down the line, we recommend beginning and preparing for that now to get ahead of any issues that crop up with data availability and resource requirement. And if we have any questions, we can either take those through the chat feature, or you're very welcome to reach out to me directly. My contact information is on the slide here as well.
Great, thank you so much, Zoe. There is so much to take in within that presentation. I have to admit, I have made quite a few notes, even though I know there's a recording coming up. Okay, we've got time for a okay, not a question, says Rachel, but this has been really useful, thank you. Yes, there's, I think, really echoes what a lot of us are thinking. My head's full of information there. I think that we do have that table available, I think, as a download as well. So what we'll do is we'll package that with what we'll send on to you following this session. I'm now going to go over to the poll. And whilst we do that, just bear with, we'll have a look at where we've got to so far with that. Okay, now, this is what our poll is saying at the moment. Excuse me, so we've asked the question of currently, which of the sustainability reporting regimes are you reporting into? And you can see on screen what those look like. Streamlined energy and carbon reporting is the one that wins the race in there. But you can see there what's coming up behind. We've got the Carbon Disclosure Project in here. We've got science-based targets, a little bit lower than I thought. Okay, the numbers are changing there as we speak. And TCFD coming up. And great, there we go. I think, you know, with SCCR, obviously that's been in place for a while now, but we can see that some of the newer standards coming in. I think the one to watch there, TCFD and science-based targets. It will be interesting to see the effect on that as the new ISO 14068 comes in. I think Zoe Booth's points are well made there. This is really going to be the first time we're going to get a definition that's independent of a particular brand. That will be the ISO standard. You can go to any of your favorite auditors and get the certification against that, and that the same should go for net zero as well. So you're not sort of stuck to one particular provider for that. Absolutely fascinating. Please keep voting, and we can share this obviously after the event as well. The next question here is the one: what are we expecting to have happen going forward? So we can see there we've got science-based targets in net zero taking the lead there. This will be interesting to see whether the ISO is going to sway that a little bit. Obviously, towards the end of the autumn, hopefully we're going to see that and know what that looks like. But I think in any effect, it would be great to see so many businesses making a net zero commitment, and that makes sense. I think that the ratio of the others is remaining about the same there. Please keep on voting. We'll see what these numbers and shapes look like. The final question we really asked was the ease of doing the reporting. As some of these regimes are in a very new state, and quite often people are asking, well, what's a good way of doing this? And you know, we've seen many very, very long reports, and we've also seen some very good, very succinct reports as well. And I'm sure maybe some of that will be picked up by Harsha in just a moment. This is what we're thinking. So some of us think it was okay doing the reporting, others, it seems to be weighted down that lower end there, didn't have so nice a time doing it. There is a panel session coming up right at the end, and so we will move on now to our final speaker. Delighted to have Harsha Thomas from De La Rue with us today.
Thank you for having me. My name's Harsha Thomas. I'm the Environment Sustainability Coordinator at De La Rue. I look after all things environmental sustainability, and made particularly of interest today, I look at compliance with sustainability reporting and voluntary framework disclosures. So my email address is up there on the presentation if anyone likes to contact me for any questions, happy to help. So let's move on. So just before I go in, I think it would be really useful if you understood what we do at De La Rue. So we're a provider of secure digital and physical solutions. we've worked in over 140 countries, and we've got two main divisions. We've got currency and we've got authentication. So currency is quite self-explanatory. We do banknotes, and in authentication we help work governments with tax stamps, brand solutions, and the ethos of our brand really is anti-counterfeit. And because we work with quite a lot of central banks, governments and multinational businesses, I think we've got, in my time here, we've got a really good culture of trying to do the right thing, and that's really important when you see the history we've been on in our sustainability journey. So going on to the next slide, I thought it'd be important, just before we go into the TCFD aspect of it, which I'm hoping is useful for everyone, I'd like to give a bit of flavour of what we've done in the past, because I think it's you build up to the TCFD and how ready you're for it. So starting 2000s, early 2000s, it was really just compliance and beyond. We did report on scope 1 and scope 2. We had ISO 14001 certification for all since 2003, and that's been expanded to a global certification for all our manufacturing sites and our head office in Basingstoke. So they're all certified to ISO 14001. And it really wasn't until our first CDP disclosure in 2010, our first public disclosure was in 2013, where we really started thinking a bit more. We started thinking, how can we lead? How can we become a bit more mature in our sustainability reporting? And I'll touch base a bit more on how that CDP exposure has helped us later on. But just so we do both the climate change disclosure, and we've recently started doing the water security disclosure as well. Going forward a couple more years, we've joined the United Nations Global Compact as signatory. So this looks at and this is where we've now committed to report on our progress against all the SDGs, covering the environmental, social and governance aspects. 2021, we've committed to setting an SBTI target. I'm really happy to say that it's now been validated, and we do have a near-term carbon reduction target in plan. And that's an absolute target for our scope 1, scope 2 and scope 3 emissions. And of course, the star of today's presentation, our first TCFD report was published in 2022. And today's slide deck is all about sharing our experience and how we've gone through the TCFD and how we've implemented. And all of this takes us back to our current state, where we're looking at expanding and committing to a net zero target. We're currently aligned with the UK government's net zero by 2050, but we also want to set an SBTI aligned net zero target, and we're in the midst of planning for that. So next slide. So to meet the TCFD recommendations, so as part of listing rule, as we are a premium listed company, De La Rue had to meet the recommendations for the TCFD from 2022 onwards for accounts starting in from April 2021 to March 2022. And the very first thing we did, as Zoe very rightfully highlighted, is that we did a gap assessment, just to see where we were meeting the recommendations and where we need to do a bit more work. And this gap assessment was split into two aspects. We did a gap assessment on adoption, and we did a gap assessment on alignment. Now, these are two very different things, but they're quite similar. Adoption for us was where we needed to adopt some of the recommendations of the TCFD, for example, climate scenario analysis, because we'd never done that before. Alignment is where we were reporting elsewhere that adopted the TCFD processes, but we just weren't stating that in our annual report. Another aspect of reporting frameworks that often gets lost in all the big ESG alphabet soup is you have to make sure you have to know where exactly you need to report your disclosures. And for the TCFD, you would either have to report it within your annual report or within a separate sustainability report that goes with your annual filings. So that's why we have that difference between adoption and alignment. So results of that gap analysis to see how ready we were. So we looked at governance, strategy, risk management and metrics and targets for the 4 pillars. Now, for governance, we were really strongly aligned, and we didn't really need to adopt quite a lot of what the TCFD recommendations had stated. One of the key aspects you could say we needed to adopt was that we did not have a remuneration target linked to climate within our governance structure. So that wasn't really well integrated. And then we did a review on those aspects and actually, can we put that in? Can we integrate that into the governance structure? Other aspects that weren't really integrated, if you look at the recommendations under governance, but we were reporting on it elsewhere, was that we stated that we had a really good governance structure in place for reporting on climate, but that we just didn't have a narrative in the annual report to say that we align with the TCFD. So this is where that difference in the adoption and alignment came in. But at the end of the year, we were able to say that we were really strongly aligned on governance. Now, strategy is where we needed a lot of major adoption, and of course that big gap we had in meeting the TCFD recommendations was the climate scenario analysis. Again, on alignment, we were reporting on some of our climate-related risks in the CDP disclosures, but we weren't really expanding it on our annual report. So to some extent, we were partially aligned, but we still needed that big adoption of this climate scenario analysis. Risk management, this is very similar to governance. We were really strongly aligned. Our risk committee, our risk committee was there. We didn't need to do a lot of adoption, but we just needed to build that narrative that we were building in our CDP responses. And I will touch base on the CDP aspect of this a little later down the slide deck. Now, metrics and targets, partially aligned, and what we needed was a greater emphasis on and need to adopt some of the shorter, medium-term and long-term targets that the TCFD talks about. This also links back to our strategy section because we hadn't done the climate scenario analysis. And if you read the recommendations on metrics and targets, goes a bit more detail how the opportunities and risks you've discovered or you've highlighted in the strategy section need to be related back into your metrics section. For example, if you have a climate related opportunity on, for example, procuring renewable energy, you could potentially, to improve your alignment with the TCFD, have a target on we will procure an X amount of renewable energy for our operations, and they're very much interrelated. Very conveniently, at the same time, we were in the process of submitting our near-term science-based targets mission. Now, because we were doing this, we were really thinking a bit more detailed about target setting, and this also really helped us align, in the end, partially align with the metrics and targets aspect of the TCFD. Now, the big thing of our TCFD readiness was, of course, our governance structure. Coming back to that governance structure, we had a very clear process where if there was a clear line of authority in terms of how risks, opportunities, all discussed in the TCFD would be passed up to the board. In addition, we've also, our CFO was our climate change champion. So we really had that strong executive buy-in. So that really helped us align with the TCFD. Really well integrated enterprise risk management. Sustainability and climate change was highlighted as a principal risk for De La Rue back in 2021. So we were already really reporting on climate risks and opportunities, and this was getting fed into this risk management system that aligned with our strong governance structure. So we had monthly reviews in a divisional format on review of risks, followed by quarterly reviews to the risk committee, which would include board members, including the CFO and CEO. And if you look at the recommendations, it really aligns well with what the TCFD recommends. And finally, it was really that CDP disclosure experience that really helped bring this all together. And like that exposure experience of when we first started doing the CDP back in 2010 and our first public disclosure in 2013, we scored an E. And in 2022, we've now scored a B. So which is really a sign of organic growth in terms of how we've improved our structure and how we respond in terms of the the governance and strategy aspects of climate change. And this is what the difference we had with our adoption and alignment in that gap analysis, because we were, let me retract there, coming back to what Zoe mentioned about the CDP being really aligned with the TCFD. When the TCFD was first announced in 2015, 2017, and in 2017 when it was adopted, the CDP started incorporating a lot of their questions started incorporating aspects of the TCFD. So in essence, if you had started reporting to the CDP, you would have essentially started aligning yourself with the TCFD, which is where we were really well aligned with the TCFD, and we didn't need to do a lot of adoption. So that was really the big difference in us getting prepared for the TCFD. The big one, of course, that we did need to adopt was the climate scenario analysis. Now, we definitely needed to adopt because this is where we were not meeting the recommendations. And this is where it took a lot of time to understand what was most appropriate for De La Rue and which scenarios to use. Now, the TCFD recommendation says at the minimum, you've got to consider 2 scenarios, one of them being a well below 2 degrees scenario. And for those who aren't aware, there's many public scenarios, for example, the IPCC 8.5 and the IEA scenarios, net zero scenarios. So there are many public scenarios. You also have the opportunity to design your own climate scenario. Of course, this is where you have the trade-off between, is this the most appropriate one for you, or does it, because using public scenarios helps you bring a narrative, and designing a bespoke scenario makes it more relatable for your business. From a De La Rue perspective, this is our first time doing a climate scenario analysis, and we really needed to just get understanding of where we stood. As I said, we've done climate risk before, and this would be climate risk reported in the risk registers that would just been brought up, but this is the first time we really had to understand where in the business exactly we were doing. So the first thing we sort of did is outline the scope of our business, and in the TCFD it does recommend that you look at all the different areas of your business. So we've looked at procurement, sales, operations, our finance and ability to finance as all areas of the business that would need to be considered in the scenario analysis. The second thing we did, coming back to those scenarios, we decided we would go for a 2 scenario process, and we used public scenarios, a 4 degree scenario and a 2 degree scenario to help us build that narrative to understand where exactly we're getting the risk. And the reason we did that 2 scenarios to build that narrative is that for the high 4 degree scenario, we modelled that it would be primarily physical risks arising, while for the 2 degree scenario, we modelled transition risk. So this helped us simplify the scenario analysis, and the intention was for our first iteration to understand where all the risks are coming from, while as we progress each year, we would be able to locate more of the material risks, and instead of doing a qualitative analysis, be able to understand a bit more quantitatively and really clarify exactly what the risks are. So we did all that, we designed all that, and the first thing we did after that is we got executive buy-in from our CFO. Because if you do not have executive buy-in, you're not going to get this culture change of understanding these climate risks, and it's not going to help support you. And once we had that executive buy-in, we set up a workshop to discuss this climate scenario analysis, where we looked at these are the most potential risks arising from each scenario that could affect the business. And coming back to those focus areas where we were talking about the finance, procurement, our operations, we brought in our senior stakeholders from each division, and we had half a day in a meeting room just discussing this is where it could potentially impact us, and this is where we are, what are the mitigating impacts here, what are the potential financial impact, because of course part of the TCFD is the financial disclosures. It's really understanding what's the potential financial impact on our business. So we had that session, and then it was followed up by individual following up with individual stakeholders in a one-on-one on some risks that were needed a bit more clarity, needed a bit more that were defined under our risk management framework as being material to just really understand. And once we had all that, we made sure we were reintegrating it back into our risk management process. Again, sustainability and climate change is one of our principal risks in our risk register, but is this also being fed back into each of the divisional and functional risk registers, and having a record being kept, and is it being monitored? So that was a really quick debrief of the full process of what we did. In terms of learning lessons from this, there was a lot. I think the biggest learning lesson was that it really promoted a lot of internal thinking to, of course, improve our external reporting. And like Zoe said, a lot of TCFD, a lot of disclosure frameworks borrow from the TCFD in terms of structure, in terms of what they ask you for. So it really, getting the TCFD and understanding it really helped us prepare for that. But more importantly, it really highlighted how important climate risk is and how much we need to think internally, not just as our ESG sustainability team, also as a business, to really understand our strategy to respond against these risks and opportunities. The second was the realistic scoping for scenario analysis. The best practice would be to at least do 3 scenarios, really do bespoke scenarios, make it really relevant for your business. But I think it's also understanding your limitations as a business and where you are, and also to just scope out the aspects of the business that you need to look at. You need to really look at the material risks, and that's what's really important here. Bring in experts across the business. Again, coming back to my earlier comment, it's not just an ESG team, it's not just your sustainability team doing this, it is all these senior stakeholders who have this knowledge that you can use to really build that profile of where we are most likely to hit. And of course, it's the real big thing about bringing these senior stakeholders is that the intention of the TCFD is not just to really get investors to provide you, for investors to have more information about what climate risks the business is facing, but it's also using these climate risks and opportunities to really feed your strategy, and bringing these experts in, getting them involved. They also get that feedback in terms of, right, this is the material risk, as what I'm doing at the moment really really useful for the business, or do I need to slightly change my strategy? So I don't think from our experience, I think there was a lot more internal retrospective thinking in terms of how we were doing in terms of business strategy. And I think the biggest thing was that we already had a lot more information in the business. And it was just a matter of getting down and sitting that together. There's a lot of information externally in terms of how you can do the TCFD as well, but it's really interesting how much information we had internally in terms of how we respond to climate risks. Quite frankly, a lot of these risks also overlap in a sense. So that was really important as well. So that was a huge learning lesson. In terms of new reporting frameworks, I have to say, Wendy, I did respond to that poll. I think I clicked on every single option there in terms of what we'd have to report on. But the biggest one that we're looking at currently is that we've got a manufacturing site in Malta, so we will looking to align with the corporate and sustainability reporting standard, as that will come under the qualification rules, as well as the international sustainability standard boards, S1 and S2. And of course, we are approaching the same way here in terms of doing a gap assessment, looking at where we align and where we need to adopt. And I think this is, again, where I want to reiterate how helpful it was to go through this TCFD process to now prepare us for these new frameworks. Especially ISSB S2, for example, is very much focused on the TCFD, breaking it into the exact same manner of governance, strategy, risk management, metrics and targets, with a little more additional reporting requirements perhaps on the strategy and metrics and targets aspects. And of course, just want to again double down on this, readiness is not limited to the ESG team. It is something that we can champion and we can drive, but it's something that needs company-wide, and it needs that executive buy-in to really get you ready for the reporting, and also to just really build that culture of change and transformation. So hopefully you found that interesting and hopefully useful as well. Thank you for listening, and that's really all for me.
Harsha, thank you so much for an excellent presentation there, and really candid explanation of the challenges you faced and the journey that you've been on there. I think that helps us all, and congratulations on such great progress that you've made with CDP. I'm going to grab the screen back from Harsha now, and actually what we will do is, if there's a specific question for Harsha, I know Malanga and Peter, you're waiting with questions. I would really like to take those into the group discussion, so we are going to get back to you in just 1 second. If there is a specific point that you want to ask, if you want to ask Harsha, if you could pop that please in the chat right now, then we will have a look at that as we go here. And whilst you think about what that is, I'm just going to pop this screen up here. This is our feedback form, and I know we're not done yet. The reason why I'm showing this now is that we would like to know topics that you'd like us to cover in these sessions. We'd like to know if you'd like to be a speaker as well at these sessions. So if you can take a moment again with your phones, get that ready. If you want to fill that in now, great. If you want to fill that in right at the end, that would be fantastic. And I think Zoe Booth is going to put the equivalent link just there in the chat for you. Okay, I am just thinking here, I'm not seeing anything quite specific in the chat function at the moment, though I do know that the 2 questions that we already have from Peter and Malanga are absolutely aligned with what you're doing, Harsha, so I think those apply equally to you. So I think what we'll do is we will open the panel discussion now. So if I'm going to suggest here that we get the presenters to make their videos available on screen, I'm going to stop sharing for a moment. So presenters, if you can be there. Okay, the first question is from Peter, who's asking about TCFD and when we might expect that to trickle down to smaller businesses. I think Peter's telling us there that his company has, I think, about 500 staff and £200 million turnover. So what panel, how are we feeling about how TCFD is going to transition, if it's going to transition to smaller businesses?
Yeah, I think that's an excellent question, and almost certainly we're going to see those requirements trickle down over time. From what I am aware of, it's expected that perhaps this will be nearer to around 2025 that this starts to expand out to other businesses. That being said, more recently, because the UK has expressed that it's planning to adopt the ISSB standards, which, as we know from today's session, also covers climate-related risk and opportunity, and as Harsha mentioned, builds on TCFD, we may see that those goalposts move slightly for businesses, particularly that are only just under the threshold of current TCFD reporting, because introducing that new framework and the requirements of that, if that comes in sooner than that 2025 deadline, then certain businesses may be needing to report in a TCFD aligned manner sooner than 2025. So certainly something to keep an eye on, I think, as we get updates from the UK government in the next, well, 12 months, but hopefully sooner, we'll have an idea of what's coming in there.
Mm-hmm. And Harsha, I'm just thinking, looking at De La Rue, obviously you've had to go early on TCFD. What's your sense of how your sector has been adopting to it, and what they would like to see perhaps within other sectors going forward?
In our printing sector or manufacturing sector, is that
yes,
I think
okay.
I think in terms of where we are in what we do, we're probably the only one that has to currently respond to the TCFD. Yep. So that's interesting. No, my sort of interest is again, I think I saw it in an earlier question, I think on the chat, about it being investor driven.
Yes.
So I think I don't think I think it's been interesting because from the manufacturing point of view, it's really been useful in terms of streamlining and just standardizing all the reporting requirements, especially because a lot of the TCFD takes into account what investors have started asking. And I think that's something that you can see across the industry. Certainly from an internal point of view, I think in terms of feedback, I think it's been really well received. I mean, we're part of the TCFD supporters group, which is really easy and free to join for anyone who wishes to join the TCFD supporters group. And everyone's been given positive feedback. I think in terms of with the ISSB rules coming, for example, I think my comment is that it'll be really interesting to see what happens. Because especially as if S2 is adopted as it is in the current form, if you do S2, you are reporting to the TCFD. And of course, since the ISSB has also taken over governance over the TCFD as well, the ISSB chair board as well. So there's a lot of things moving really fast. So I'm sitting here in my chair going, right, I'm really interested to see what's happening with these reporting frameworks and what's going on. But in terms of what's happening, in terms of like what I've heard, it seems to be going smooth. I think everyone's going at their own sustainability journey, and that's really important. The other thing I will say is that, and this is really important, I mentioned in my slide in the text, but I didn't really say, is that comply and explain basis at the moment for TCFD until 2025, I think. So correct me if I'm wrong, Zoe. So in our first year of doing TCFD reporting, we really took advantage of that, explaining that we were not aligning with, we did not adopt scenario analysis. So if you're still in the process of thinking, and when it comes aligned, you know, there's still a few companies out there doing the explaining bit because they're still trying to really incorporate it into their strategy and their governance aspects of it. So and there's like little steps, so it's really an iterative process, I think. So it's still sort of an ongoing process that's still happening. Just to digress there.
Absolutely. I think comply or explain is quite key. I think for some of these nascent reporting regimes, that's so important, actually. So many companies that we work with can go full out thinking it's got to be perfect, it's got to be perfect, but I don't know what it needs to be. And that comply or explain is really important and makes it a bit more pragmatic. Probably leads me in, I've had a few questions that have been pre-submitted, and this one actually fits very nicely alongside both of those questions there, which is I'm going to say, alongside De La Rue's TCFD report, what good TCFD reports are in the public domain would you suggest that people look at? And I can really identify with this, because I think we've all seen TCFD reports which are as long as you like, and some which are much shorter. And really, I think we all have a sense of a bit more security seeing one we think this is a good TCFD report, this has enough in it, rather than being something which is sort of thus thick. Yeah, any suggestions there on what we should be looking at as a good
Absolutely,
example of a TCFD?
I was in this place a year ago.
Yes.
Trying to think about watch format, and there are really some big ones. You've got Unilever, you've got Lancet, to name a few that just comes immediately to my mind, because I remember looking at their TCFD reports. There's Orsted as well. There's certainly I'm trying to remember what else. Mondi, I think. So there's a few, just to name a few. But there's certainly one of the good things to really look at would be if you look at the Transition Plan Task Force, which is looking at transition, which is issuing transition plan guidance. There's a few big brands on there.
Yes.
And they're very vocal about what they do in terms of their ESG and their climate strategy. I tend to find that in my quick cursory search there, they've got really good TCFD reports. So if that's something if you want to look at the members of the Transition Plan Task Force, particularly which companies are there, it's very likely their TCFD reports are quite probably at the highest standards.
Great. No, that's good advice there. Good stuff. And this is probably linked into Peter's comment here, which is, can I / should I voluntarily submit to any of these new reporting mechanisms? I think here maybe we could take TCFD, maybe as that one's more advanced. I'm not, you know, can you submit even if you're not required to, and what would be the benefits of doing that?
Absolutely. I don't know if you want to take this, but
yeah,
but
100%,
there's always
yeah.
early adoptions. Early adoption is always allowed. Of course, TCFD came in. It was first announced 2015, and the draft rules were set in 2017. I want to say, correct. And you've had these big companies start doing their own TCFD reports starting 2017, 2018. So before it became mandatory for them in 2022. Again, with the ISSB S1 and S2, early adoption is also encouraged. So, you know, if you've got the resources and if you're ready to go for it, you know, please just start doing it, because you'll be better prepared for when it does become mandatory.
Yeah, just to add to that as well, I certainly agree with Harsha that the sooner you begin preparing for these disclosures, the better, because it will enable you to, hopefully, by the time you do come to report under requirements, if it is mandatory for your business, you'll be much better prepared with maybe a few years under your belt, ironing out the teething issues, identifying issues where data wasn't available where you would have liked it to be, and not forgetting, ultimately, with a lot of these frameworks that are including climate risk, so we're talking about TCFD and the risk to investors, but also the risk to the business. And we're seeing now real life impacts of climate change for businesses, especially in certain areas of the world. So not only is it great to have it on paper for mandatory disclosure requirements, but also to prepare as a business so that if something does come up that poses a risk in the real world, you have already begun to consider that. Or if you are then asked for it from an investor, or, you know, for similar reasons, you have the answer perhaps ahead of when you may be expected to have it. So there's no reason why it wouldn't be a great idea to begin preparing sooner rather than just waiting until you have to, if you can.
Great. There's one final question on email. I thought this one would come up, which is, do the panel think that ESOS will get rolled into SECR, streamlined energy and carbon reporting, going forward? Obviously, we're at the final stages of ESOS phase 3, which hasn't always been the most favourite programme in the world, and there we are with SECR at the moment being basically carbon reporting, but with energy in its title. So would we like to see ESOS all wrapped up into SECR? Just some general thoughts. Obviously, these won't necessarily reflect the opinions of the organisations here. What are our thoughts on ESOS and SECR?
I certainly hope so. My sort of approach to that. No, I think that's, you know, a really valid question, especially because a lot of what you're doing for ESOS really overlaps with what's being, you know, done in SECR. Especially when you do the data collection for ESOS, you're essentially feeding it to SECR, because you can do that quite what's the word for it together.
Yes, back to back,
yes,
isn't it?
Back to back. So it really feeds into each other. And of course, it's quite interesting with the ESOS. You're required to identify I think the difference for me is that you're required to identify the energy saving opportunities. While in SECR, you are required to report on what energy saving activities you've done in the year. So there's that very, very slight difference. So personally, I would really like to see what happens. My sort of approach is, given that the Department of Net Zero is bringing in that new legislation, making those changes to ESOS. My sort of thoughts are it's going to get very similar. Very similar to what we're already doing. So hopefully when legislation comes through and we all know what we have to report for ESOS, it's probably not too much of a heavy task to make those quick changes. But at the end of the day, if it's a duplicate of each other, I really would just like to see it all amalgamated into SECR. But that's my personal sort of approach to it.
So it is interesting. I mean, if we talk about sort of being in a business or being consultant side, the idea of a ethos being every 4 years, unfortunately gives enough time for everyone to have forgotten how to do it, which doesn't help from a client position. From consultant position, obviously a whole heap of work comes all at once, but only once every 4 years, which can, I think, for some consultancy businesses can be quite a resource stretch actually. But I think with that and with multiple reportings, and we've seen throughout here, there's a general consensus we need less reporting when they are so similar. Let's truly have it in a streamlined fashion. Let's have it truly unified there. Great. Okay. I can't see any more questions coming up on the chat there, but I think that's been an absolutely fascinating run through of those submitting ones there. I'm going to do a shameless plug now for our next Sustainable Business Network event. Is a live event. We don't do too many of these, so I'm hoping we can tempt people who are in Hampshire and the local region to come along to the fabulous Marwell Zoo. Why Marwell? Well, it's very nice over there, and also my colleague, the very excellent Dr. Duncan East, works at Marwell and is the sustainability lead there, so that's why we're lucky enough to host the session at Marwell Zoo. That's on B Corp and social certification, so please do scan in that code and book your places. Obviously it's limited number of places because it's live. Some final thank yous from today. Thank you for all our speakers, Zoe and Harsha. Absolutely fascinating, and really brought the topic sometimes can be a little bit dry really to life with case studies and all the tips and advice there. Thank you so much. I need to thank our sponsors today, Rushmore Borough Council, Hart District Council and Basingstoke and Dean Borough Council, without whom these sessions would not be possible. And you've got on the screen there the QR for the feedback form, so scan away with that, and that will be really much appreciated. So all that remains is for me to say thank you so much for joining us this morning, and we look forward to seeing you on the next SBN session.